Anthony, founding partner of Legal and Compliance, a corporate securities and business transactions law firm. In today's Lawcast, I am going to give a brief explanation of specific rules that govern penny stocks. For more detailed information on the topic covered today, I encourage you to read my blog titled Penny Stock Rules and Broker-Dealers that was published on November 4th. In last week's blog regarding FINRA's request to eliminate the OTCBB, I touched upon the importance of penny stock and significance of penny stocks related to the OTC marketplace. As I'll explain further, a penny stock is a low-price security, generally under $5, and is a security considered highly speculative and risky. Generally, penny stock rules focus on the activity of broker-dealers in effectuating trades. As a result of the risk associated with penny stock trading, Congress enacted the Penny Stock Act in 1990, which requires the SEC to enact further rules requiring broker-dealers to provide disclosures to customers effectuating trades in penny stocks. The rules prohibit broker-dealers from effecting transactions in penny stocks unless they comply with the requirements of the Exchange Act and Rules 15G1 through 15G100, the penny stock rules. In addition to the broker-dealer regulations, as touched on last week, Section 17B of the Exchange Act, which was enacted as part of the Penny Stock Act, regulates automated quotation systems such as the OTC markets and requires that the SEC facilitate the widespread dissemination of reliable and accurate last sale and quotation information with respect to penny stocks. A penny stock is defined in the Exchange Act under Rule 3A51-1. Like many SEC rules, the penny stock rule begins by including all equity securities and then carves out exemptions. So, a penny stock is defined as any security, any equity security, other than one, who's issued by an issuer who has net tangible assets in excess of $2 million if that issuer has been in continuous operation for at least 3 years, or $5 million if the issuer has been in continuous operation for less than 3 years, or has an average revenue of at least $6 million for the last 3 years, or 2, has an inside bid quotation price of $5 net of broker-dealer commissions, markups, or markdowns. 3 is registered on a national security exchange. 4 is an NMS stock that is a reported security and has certain quantitative standards for listing. I'm not going to get into what those standards are, but needless to say, NASDAQ and NYSE MKT meet those standards. 5 is issued by an investment company registered under the Investment Company Act of 1940. 6 is a put or call option issued by an options clearing corporation. Or 7 is certain registered security futures products. Okay. Broker-dealers are required to comply with the penny stock rules centered around the disclosure of risks and other market information associated with the transactions, and also must make determinations of suitability prior to a customer engaging in these high-risk transactions. The rules make it unlawful for a broker-dealer to effect a transaction in any penny stock for or with the account of a customer unless prior to effecting the transaction, the broker-dealer makes a determination of the suitability for penny stock transactions for that specific customer and delivers a written document on that determination. In order to approve an investor's account, the broker-dealer must obtain information regarding the investor's financial situation, investment experience, and investment objectives. No suitability determination is required for existing customers or established customers. Established customers are those that have been trading with that broker-dealer for over a year or have other experience in penny stock transactions. It is also unlawful for a broker-dealer to effectuate a transaction in penny stocks unless they furnish the customer with a risk disclosure document called a Schedule 15G. Schedule 15G is commonly referred to as the penny stock disclosure document. The Schedule 15G describes the risk of investing in penny stocks and the broker-dealer also must have the customer sign and return the risk disclosure document. The form Schedule 15G is available on the SEC website. It is really basically a warning of the risks associated with penny stocks and contains a toll-free number for customers to check on their broker-dealer or to file complaints. If the risk disclosure document is sent by email, it can't contain any other information. It has to be the only thing in the email. The disclosure to the customer also, the broker-dealer also must disclose to the customer the inside bid and offer quotation of the stock and the number of shares to which the bid and offer apply. Finally, the broker-dealer must disclose to the customer their compensation, including the compensation that's going to the firm and the compensation that is going to the individual broker handling that customer's account. Broker-dealers also must send customers monthly statements showing all of their transactions and especially their penny stock transactions. The SEC also requires a cooling off period. The broker-dealers must wait 2 days after making a suitability determination and 2 days after receiving back the signed confirmation of the risk disclosure document before they can effectuate a transaction in penny stocks for that customer. A Schedule 15G is not required in certain circumstances. A Schedule 15G is not required for a Reg D offering where it's an institutional investor or where the customer is the officer, director, or 5% or greater shareholder of the issuer. Or if the customer requests the transaction and the broker-dealer is just effectuating it and did not make any recommendation. I'm securities attorney Laura Anthony, founding partner of Legal and Compliance. Should you have any questions about any of the information we've just covered, please visit securitieslawblog.com or contact me directly. Inquiries of a technical nature are always encouraged.